risk solutions. Marsh provides personal and business insurance solutions to protect our clients' businesses for future growth while offering lasting peace of mind.
Good morning to all our delegates and welcome to the Marsh Alternative Risk Transfer Vehicle webinar. I mean, given that it's in October and I'm based in Joburg, I don't know about you, but then I had to double check myself this morning if I'm in Joburg or I'm in Western Cape, because especially the way that the weather has been playing out in the last couple of days, it's very gloomy. But I think back to today's order of the day, by definition, alternative risk transfer, ART, is a risk protection that is done outside of the traditional models of insurance programs. ART blends risk retention and risk transfer at the lowest total cost of risk and results in mutually aligning the financial interests of both the insurer and the insured. Research informs us that ART techniques represent the crown jewels in the risk management arena. This non-traditional method of insurance has gained prominence over the last few decades. Thus, if insurers recognize that the risk management paradigm is changing from indemnity to value creation and enhancement, they can stem the flow and the lively players in the evolving corporate risk management marketplace. The reality is that the tide is inclining towards the ART techniques.
Thanks, Pat. And from our side, as always, it's from a Marsh's side, it's always great to be partnering with IMSA on an event like this. We've been acknowledging the work that IMSA is continually doing on the risk managers for the risk managers community, and therefore we value the partnership we have with IMSA. A good morning to you all, and thank you for joining us on this webinar. As mentioned, my name is Monet Lorenz. I head up Marsh Advisory, the Africa division that specializes in risk consulting. Before we kick off, there's a few house rules that I want to go through. Firstly, this webinar is scheduled to run until 11:15 this morning, and we want to keep it really interactive. All attendees you'll see are muted, so unfortunately, there will not be any verbal interaction. However, if you'd like to chat to any of the presenters or a colleague you recognize, you may use the chat box at the right side of your screen. For those burning questions to any of the presenters, please make use of the Q&A tab, and I will try and facilitate answering some of these at the end of the session. Also, let's use the hashtag live with IMSA and all social media platforms during this webinar for us all to be part of this conversation. And lastly, at the end of the session, please complete the survey to give us your honest feedback. Now, as advisors in the current challenging insurance market, we are challenged more from our clients who wants to see alternative. This morning, we have the privilege of bringing to the table specialist advisors from both Marsh and Risk Connect that will discuss the importance of alternative risk transfer vehicles, as well as what impact the recently released joint guidance note will have on foreign captive insurers. Our opening speaker this morning is Gerrit Coetzee. He's a chartered accountant with 3 years experience in the insurance industry. He's part of the Marsh advisory team, and he currently heads up the risk finance division that specializes in all types of risk finance structures. Over to you, Gerrit.
So good morning, everyone, and thank you for the opportunity once again. As pointed out by Monet, it's really a privilege. And yes, it's more of a Cape Town day today than a Joburg day. Today, I'll be taking you through alternative risk finance vehicles and the landscapes in South Africa. Just as a side note, the first portion of the presentation will be done by me. Specifically, I will look at risk transfer, alternative risk transfer vehicles and possible solutions to unknown future. And my colleague Desi Reddy, who heads up our captives in Marsh Advisory, will deal with the joint practice, joint guidance note issued by the Prudential Authority and implications for these vehicles from a South African context. To start off with, I think if I try to look for a picture to paint sort of the landscape of the current insurance market, not only in South Africa, but actually worldwide, you know, and possibly a word that can describe it. And the only picture I could find that really for me encapsulates the whole situation we are in, you know, in a word, devastation, was the following picture. And I think I've been part of several renewal meetings in the last couple of months, and even last year already, this trend was coming through, and a message conveyed, between the brokers and the clients, and also from a Marsh advisory sitting into these meetings, has followed the same trend: hard markets, increased pricing, capacity constraints, and in addition, the increase in uninsurable risks. The reasons are fairly obvious due to recent claims as a result of natural catastrophes. We all know about global warming, the impacts of flooding around the world, and the strain that the insurers are actually feeling due to these. The effects of COVID-19. Unfortunately, we can't even speak of COVID-19 as a past event. We are still living COVID-19, and I believe there's another wave on its way. We're also dealing with a low interest rate environment, and as a result, there's a recessionary there's an environment of recession around the world, and that has had an impact on market capacity and insurance. So, on top of that, about a week ago, I had a casual conversation with one of our brokers who's been in the industry for 25 plus years. And to quote him, his words were, "I've never seen the markets like this in all my years." And to add on that, he mentioned something that was quite interesting, that from his perspective, pricing at the moment is in such a state that he's not even looking at pricing. His main objective for clients at the moment is obtaining market capacity. And that really paints a very grim picture. And on top of that, and to lead this conversation, it brings us to the topic for today. And what can entities do to hedge themselves for pricing increases and limited market capacity? I believe a possible solution, and therefore, it's not an ultimate solution, but a possible solution is to investigate the insurance programs and the possibility of restructuring with a view to set higher self-retention levels and utilizing an alternative risk finance vehicle to house these retentions. Now, what is the benefits of a risk retention in a structured vehicle? I mean, there's always a question about, having, if we do go the route of retaining more risk as a client, do we take it on balance sheet, or do we use a risk retention alternative risk transfer vehicle? And there's a couple of points that I can mention here today. The one is, it could assist with a reduction in the cost of conventional insurance. Now, that is whether it's in a vehicle or not, but there's a possible saving on your risk transfer premium due to higher self-retention vehicles. That benefit you will obtain whether it's on or on your balance sheet or in a risk transfer vehicle. Secondly, it allows companies to retain risk and share in the profit potential of the integrated risk management program. In years with a good claims history, the entity will be able to retain these benefits in the structure, and there will be a focus on building capacity. And I think if there's one word that I'm going to highlight a couple of times this morning, is the impact of, or the idea of building capacity, creating a hedge for yourself, for future uncertainty. The following point that the risk finance vehicle the benefit of a risk finance vehicle is it gives you access to direct insurance and reinsurance market in local and international markets. And in addition, commissions on reinsurance can be captured in a risk transfer vehicle for capacity build. There's always a selection of investment instruments to enhance returns and increase capacity depending on the risks. So you're getting growth in a vehicle on any funding that's sitting in these vehicles. And there's also a flexibility to create customized insurance programs to respond to entity-specific risk exposures. For me, the following point is an important one. Budgeting certainty in that the cost of the risk can be determined more accurately. Once a structure is in place, the total cost of risk, meaning self-retention and your risk transfer premium, can be managed more effectively for budgeting purposes. If I can give you an example, if an entity decides not to use a risk retention structure, but rather house the risk on their balance sheet, then as a director, and hypothetically, as a director, I would be uncomfortable knowing that I have a cash flow exposure on possible claims due to my higher self-retention from my balance sheet, which has not been reserved for. So alternative risk transfer vehicle gives you the ability to build reserve and capacity, so it's not just, you've got a possible future liability. That liability is backed by cash. And then lastly, its ability to underwrite risks that have become uninsurable uninsurable in conventional insurance market using excess capacity to underwrite these risks. Now, this, in a view of directors and officers, and we can even go to trade credit, where certain entities are able to place 100% capacity on their trade credit risk, as an example, and D&O cyber. It's either becoming, you can get capacity, but it's so expensive, or it's expensive, but also you can't actually place 100% of the capacity. And that's why I believe, with a forward-looking view and starting, it's almost the same concept as, and everybody has heard this, you need to start saving early, and even if it's a small amount, with a future view. Now, I believe we need to take the same sort of view, in the landscape of insurance. Yes, not everybody has got cash just to put away, in a self-retention structure, with a future view, so if and when it might happen. But if we take like a 5-year view or 3-year view, and we start with a program and structuring a program to build up capacity, then these hardening markets and uninsurable lines will become less of a problem. And I do think this trend is going to continue going forward. In South Africa, and I've gone through the why you would want to use the alternative risk transfer vehicle. The following slide basically gives you a high-level overview, of the risk transfer vehicles available in South Africa. And I've also tried to illustrate this from probably the most simplistic vehicle, which is the contingency policy, to the complexities on the bottom of a wholly owned captive. Now, if we look at a contingency policy, a couple of points I can note. It is simplistic to set up, and it's very flexible. There's no capital requirement. The insurer would charge a fee for setting up this facility, a yearly fee, and that fee basically takes care of them carrying capital on your behalf. In addition, all the regulatory requirements as an insurer. The idea is really here in a contingency policy that you are getting access to an insurance license to be able to underwrite your own risks. And it can, a couple of other points, it can underwrite insurable and uninsurable risks. It can provide access to local and international insurance market. So you can reinsure out of this facility. The second one is a cell captive. Now, the biggest differentiator between a cell captive and a contingency policy is really the fact that a cell captive has got a capital requirement. So the insurer does not carry capital on your behalf. So based on your risk profile and the risk that you're underwriting in a captive, that will drive your capital charge or requirement. Also, to point out, if we are setting up or a client is setting up a contingency policy, the advice would always be to look at, sort of start small with a contingency policy. And maybe if this facility grows, and there's benefit from a cost perspective, then consider a cell captive, and we can convert it to a cell captive. But they are very similar. The last risk finance structure is a wholly owned captive. Now, wholly owned captive is really like your own insurance company, which you as an entity would own 100%. You would need to apply for insurance license. You need to have like a business plan to support, the insurance license, all the regulatory requirements, just like one of the big insurers. So let's say, for instance, a Santam or a Momentum, all those requirements, you would also need to comply with those. It also requires, your own capital. Now, interesting to note, on a wholly owned captive, your capital requirement will most likely be much more than in a cell captive environment. The reason for it is if you are basically running your own insurance company, then that insurance company needs to also carry capital for catastrophic risks or events. In a cell captive environment, that sort of risk is spread between all the cells that is held by the insurer. So I've noted the capital requirements. There's regulatory returns required. You need to appoint a board of directors, a risk committee, an audit committee. You've got financial statements. It is a full-blown company. And for me, it's almost like the lesser preferred vehicle, if we are putting forward a proposal to a client. we would much rather get the same benefit out of a cell captive, where all of that management and administration burden is basically done on your behalf in a contingency policy and a cell captive environment. But ultimately, the idea of all these vehicles really is self-retention and building capacity. So if I go to the next slide, I've got an illustration here of the concept of building capacity. And you'll notice I've got on-balance sheet financing, risk finance, structure financing, and risk transfer premium there in the different colors. Earlier, I was actually wondering, I've got a dark blue, a light blue. What do I call the middle one? Just a medium blue. I'm not too sure. But the concept of building capacity in a risk finance vehicle can be illustrated through the diagram. For balance sheet, for on-balance sheet financing, this would be your 1 in 1 year losses. The concept is easy. If every year you are, and based on your claims history, you expect to incur a certain amount of claims, then it would make no economical sense to actually put that in a risk finance vehicle. In a risk finance vehicle, we are typically looking for your 1 and 2 year events up to a 1 and 10 year event to really get a benefit out of reserving. And you can see, I mean, I haven't added the years, but let's say hypothetically, you've got the first tower there is year 1, year 2, year 3, year 4, year 5. You'll see the idea is, and based on your claims history, etc., the idea is with the blue to build capacity and eventually have less reliance on the markets. If I go to, and just another interesting point to note is, if we look at take a global look at what is everybody around the world doing, because the concept of cyber being expensive and D&O is not only a South African problem, it's a worldwide problem. So what are all the other entities around the world doing, and what is South Africa doing? Now, if we look at the global landscape, cell captive experienced the most growth in 2020. So everybody is taking is realizing the concept of, to be able to hedge ourselves, we need to put a structure in place and start looking at self-retention. On my next slide here, and this is from our global landscape report. Later on in the presentation, we've got a QR code, which you can, scan with your phone. And that QR code will give you access to a free copy of the global landscape report. And it makes for some interesting reading. So just to highlight a couple of things here. The increase in protected cell companies, so PCCs, in South Africa, we just call it cell company. If it's an, some of the foreign cells, they refer to it as a PCC. But protected cell companies, there was a 50% increase in new formations in 2020. If we look at in terms of new premium written in these cells for their directors and officers, 50% increase, cyber 54% increase, and excess liability 10%. So there's a big focus on directors and officers and cyber. And I've also recently been on a renewal with a client where we normally expect a hard increases with cyber and with D&O, but interesting enough, their assets program had a significant increase. And I think based on what we've seen in South Africa over the last, I can't even remember when was the riots, but it felt like yesterday. We should look at not only those two lines, but those two are the ones that stand out. So D&O and cyber were the top two coverages written in cell facilities formed in the first half of 2021. So it's pretty recent. And then a number of captives writing cyber grew by 13% from 2019 to 2020. But by 127% in the last 5 years. And that is my message for today. Before I go to the Q&A, my message for today is really that, the only way that we're going to get any sort of hedge or protect ourselves from the hardening insurance market is really looking at our self-retention layers. And in self-retention, it can be on balance sheet or it can be in a structure. But I do think that a structure gives you a bit more of a formalized plan, and a goal to work towards to to ultimately not be in a position where you actually, you are helpless. You just need to absorb or decide not to have the cover. And I don't think that's really a thought that anybody, can sleep with. Thank you. That is it. In terms of my presentation, I'm not too sure if there's any.
Thank you, Gerrit. It's quite interesting. It's an alternative. The message here is alternative solutions. And since the webinar started, I've lost connectivity on my computer. I went to the alternative, which was the iPad. That one has lost as well. I'm now on my third alternative, being my phone. And my name is also now changed to Volker's name. So it's been, for me, it's a day of alternatives. But maybe a good question that comes from the panel that I quickly want to raise with you. And I think it's a general one we're getting in terms of like providing cash and providing cash for vehicles. The question that came through is basically saying, why not use funds in an approved fund on balance sheet that is audited and approved by the auditors? The contingency policy is just like having a savings account, but it carries the administrative costs. Such costs are not necessary if the company has a fully fledged claim and risk department. What is your opinion? So I think it's a really good question in terms of reserving cash. Your view on it, Gerrit?
I think, if you're going to set up if we look at a company strategy and managing its risk, it's very easy to say, let's just keep it on balance sheet, and we'll keep the cash, and hopefully something doesn't happen. And I think it also plays within your risk-bearing capacity. If you look at your risk-bearing capacity and it comes out with a huge number that you're able to absorb, then by all means. But if you are sort of tight on cash, you need to have some discipline. And I believe a contingency policy or a sell captive or a risk transfer vehicle just gives you that ability to actually structure your program and have a look forward, than just having it almost like informally on your balance sheet. And even when it happens, we'll worry about it. I think, like I mentioned earlier, if I was a risk manager at the company and, I'm doing my presentation on my insurance renewal, and the message is that, we need to take a higher aggregate or higher deductibles, and it's significantly more just to keep our total cost of risk a bit lower. And, I go to my board and say, gentlemen or ladies or gentlemen, we've taken all these extra, aggregate, lift in claims. The exposure might be this, but we don't think it's going to happen, but we're just going to keep it on balance sheet. I think as a director, I would want to know that, what is the plan and how we're going to manage it. And I think it's very difficult sometimes to almost ring fence cash, for if and when. Where a structured solution just gives you that sort of formality where there's a policy governing it, etc.
Thanks, Gerrit. Maybe just a follow-up question on that. From the cash, as you mentioned, if you have a set cash balance, is there an alternative where you don't necessarily have to put that cash down at a starting point? So, if the risk is, let's say, 2 million rands, and coming back to the question from the creating a 2 million rand bank balance, ring-fence bank balance, is there like something else, maybe giving you more? Is there a contingency policy or a structure that gives more capacity for the funding putting down?
Yeah, so there is an alternative in the market. It's called a spread loss facility. So a spread loss facility basically gives you it gives you the option where, let's say, I'm gonna play around with a couple of numbers. So let's say your exposure is 100 million. There's a real chance with self-retaining that you might have an exposure of 100 million. But you can't put 100 million away on day one. It's just not possible. You might only have 20 million rand, So the risk is that let's say in year 2, you've now put in 20 million, another 20 million, and now 100 million comes. Then you are short with 60. So that's where a spread loss facility comes in. A spread loss facility will give you 100 million. So it's an agreement you enter into with the insurer. And they give you the cover, the full 100 million cover. And it's basically financing it over the 5 years. So every year, more or less, you'll put in 20 million in the facility. But the benefit that it gives you, if should the claim happen in year 2, and you've only had, contribution of 40 million, the insurer will pay the whole 100 million out, and then there'll be a catch up, but it spreads the loss. So, but with that being said, it is a financing sort of agreement, and there's always some credit, credit vetting that takes place before an entity can qualify. But it does give you a solution, for you, and gives you a cash flow protection.
Thanks. Thank you, Gerard. Thanks for that. Some good insights there. Our next speaker is Desigan Reddy. He's also another chartered accountant with 7 years experience in the insurance industry. He also forms part of the Marsh advisory team and is responsible for the overall management and coordination of our local and international captive management projects. Des, please tell us a little bit more about this recently released joint guidance note from the Prudential Authority.
Good morning, everyone, and thank you for joining me today as we take a closer look at the recent changes to the South African insurance legislation, and in particular, how this affects foreign domicile captives insuring South African risks. On the 30th of August this year, the Prudential Authority, in conjunction with the Financial Sector Conduct Authority, released Joint Guidance Note 1 of 2021, which sought to address foreign entities insuring first-party risks in South Africa. The guidance note concluded that foreign domicile captives writing first-party risks would need to be registered under the Insurance Act 18 of 2017. Now, before we dive into how this happened, we first need to understand the licensing requirements of the Insurance Act and how this applies to foreign domicile captives. In order for an entity to be required to be registered as an insurer, conditions set out in Section 5 of the Insurance Act need to be met. Now, there are two conditions under Section 5 and they both need to be met in order for an entity to be licensed or to be required to be licensed. Now, the first one is that if an entity is conducting business similar to the insurance inside and outside of the Republic, the entity would be required to be registered. And secondly, where a foreign insurer either solicits insurance business directly from a South African subsidiary or its parent company, or indirectly through an intermediary or by appointment solicits insurance business, they are required to be registered. Now, in 2018, when the new Insurance Act was adopted, there were various views on whether a foreign domicile captive was seen to be soliciting business within the Republic. And this is because a South African parent entity sets up its own facility overseas. There was no solicitation of insurance business from the actual captive, but rather a setup from the parent company. And it was the view that foreign domicile captives were not soliciting a business within the Republic and did not require to be licensed. And in 2019, the Prudential Authority then agreed with this when they released a Joint Guidance Note 1 of 2019, and you'll see that on the following slide, where the Prudential Authority sets out broad terms of how Section 5 of the Act should be applied. And in this joint guidance, there was no explicit mention of captives or foreign insurers. And therefore, it was concluded that foreign domiciles did not need to be insured, or did not need to be licensed. But it must be noted that while there was no mention of captives in the 2019 Joint Guidance Note, it did make note that foreign insurers, foreign insurers writing risks in South Africa, are seen to be soliciting insurance business within the Republic and would need to be registered. The loophole there was just, they didn't include captives under the definition, and therefore there was no requirement for captives to be registered. Fast forward 2 years later, and subsequently the South African regulator has changed the game for foreign domicile captives. Joint Guidance Notice 1 of 2018, released earlier this year, sought to include captive insurers within the definition and concluded that captive insurers domiciled in a foreign entity, a foreign territory, writing first-party risks, would fall within the ambit of Section 5 and would consider to be soliciting insurance business within the Republic. In this instance, both conditions of Section 5 of the Insurance Act now would be met, and foreign domicile captives would now be required to license as a full insurer within the South African Republic. This joint guidance makes this very clear, and the Prudential Authority specifically includes captive as being an entity writing first-party risks, and they define first-party as being operational risks of its parent company and its subsidiary. Therefore, there's no ambiguity in this, and it clears this up that foreign domicile captives will now have to be registered within the Republic. While the Joint Guidance Notice does make mention of an exemption that is applicable, after numerous discussions with the PA and the FSC around this topic, the exemption can only be applied to requirements of insurers under the Insurance Act, but it does not exempt a foreign domicile captive or its parent company from registering as an insurer. Therefore, it's quite clear that the Prudential Authority wants foreign captive insurers to be licensed and to be regulated under the Insurance Act 17 of 2018, or 18 of 2017, sorry. Now, given that this is what's happening, what is the way forward? What are the options for foreign domicile captives within South Africa, and what action can be taken? And the way I see it, for foreign domicile captives, there are three options. The first option is to register as an insurance company under the insurance license of South Africa. However, this would create a regulatory compliance and a governance burden, because now you would have two registered entities, one in the foreign domicile as well as one in South Africa. And as we know, South African insurance legislation creates a large burden, especially with the regulatory requirements, the governance, and the solvency and capital, right? And to these, when we talk about setting up an insurance captive, we talk about setting up a board and its subcommittees, governance and compliance frameworks and policies, as well as solvency and capital requirements. Now, the PA and the FSCA has alluded to exemptions being allowed for some of these requirements. But when we apply our minds to it, it's hard to see, because South Africa as legislation is quite intense and is quite burdensome. It's hard to see, for example, a regulator granting dispensation on South African solvency and capital requirements, where offshore and foreign captives have a lower solvency and capital. So under this method, you would have two fully licensed insurance companies. Operationally, it will cost the same on both, and you would have two separate capital requirements, which wouldn't be effective, but that is the way the South African authorities want us to go. The second option I foresee is making use of a South African or a locally based cedent insurer. Now, this relationship would work where the parent company writes business and has a policy with a South Africa cedent insurer. This cedent insurer then retains some of the risk and then cedes the rest of the risk to the already existing foreign domicile captive. Now, this is a good option. However, we must be cognizant of the fact that when this arrangement is put into place, the foreign domicile captive becomes a reinsurance captive rather than a direct writing captive. Now, why this is pertinent? Because in certain foreign domiciles and in certain domiciles, reinsurance is seen in a different light to insurance, and they may come with its own other regulatory burden, capital requirements, and compliance and regulatory requirements as well. Then the third method, or the third option rather, is de-recognizing the foreign captive and putting the foreign captive into runoff and utilizing a local alternate risk transfer vehicle, as my colleague Gerrit alluded to earlier. And in this option, we can use vehicles that are less burdensome than a wholly owned insurance captive, such as the contingency policy and the cell captive. But in this method, you will again have two entities existing for a while, and especially when you put a captive into runoff, depending on the risks and the long tail of this, you will have two entities with two separate capital requirements. But using a cell captive and a contingency policy, the operational costs and the solvency and capital requirements will be much less than operating a fully licensed insurer in South Africa. So those are the three options we see based on the joint guidance notice. And having communicated with the Prudential Authority, it is clear that the time for action for foreign domicile captives is now. Thank you very much.
Thanks, Desigan, for that. Maybe a quick question on that. You've given the options, as alternatives, but we all know that especially setting up a captive, is quite an onerous process, quite a long process. And I mean, loads of the community might have a foreign as an offshore captive that's in a different jurisdiction. And now they don't want to go to alternatives. They're comfortable with the process. They're comfortable. The board's been settled. They don't want to change that. So if they then decide to license their foreign domicile captive in South Africa, is that possible? And how long will this process take about?
Yes, Monet, it is definitely possible. And there's definitely a process set out by the Prudential Authority on how we can make this happen. So the one is by applying to the Prudential Authority for an insurance license. And in this process, you would have to submit all your insurance policies, so all your first-party policies, as well as a business plan and a solvency and capital requirement sort of outlook. And in this, you sort of set out the budget for and the business plan for this captive, which should be quite simple, as you know, the foreign domicile captive has already got this information and you'd be pulling it from there. So that's the one aspect of obtaining a license. The second aspect, and this is where it gets a bit tricky, is your governance and regulatory structures. So now for a South African-based insurer or a captive, you would have to go and source directors, and you'd have to apply to the Prudential Authority on the fit and proper basis. So you would need directors, its subcommittees. You would need head of internal audit, head of actuarial functions, head of compliance, risk management, and all of these applications would need to go through to the Prudential Authority, and they would apply their minds and approve these persons under this. We would also then need to set up an audit partner, and also you would then need to set up management of this entity as well. So that's the process. And to answer your question, so depending on how many policies you write, how big your insurance structure is, and how quickly you can get your governance structures, this process can take anywhere between 3 to 6 months to set up. And obviously, with the impending joint notice guidance that has come out now, obviously the Prudential Authority wants action. So the advice from the Prudential Authority is engage with them and let them know that you've seen the notice, you know you need to act, and this is your plan. But if companies, and we're sort of seeing it now, if companies go into renewal, after this joint guidance notice and don't notify the Prudential Authority, I think they're going to take a harsh line on that. But once we engage with them, they become a lot more understanding to the circumstance of each individual foreign domicile captive.
Okay, thanks. Thank you very much, Des. I think that was really, really insightful. I'm going to ask the panelists also we're going to respond to some of the questions that came up on the chat function on the right-hand side. So I'm going to ask the specialists to basically start answering some of those questions, just so that we can keep in terms of time, so that we can finish when we're scheduled to finish. Now introducing our last speaker for this morning, it's Volker von Widden, who's a specialist risk consultant to the Risk Connect organization in South Africa. From 2003 to 2016, he was responsible for the deployment of specialist risk practice disciplines in several geographies. His risk management experience reflects the in-depth analysis applied to each industry of segment. Volker, can you maybe give us some broad insight on the strategic alignment of these various ART vehicles within risk management?
Thanks, everybody. So we have a strategic risk line in Risk Connect, as well as a lot of operational risk competence in the business, and it's an international organization. It was formed about 8 years ago. The theme that I'm taking is really separate to the discussion of the products and the vehicles. I think that's been well attended by the Marsh colleagues, and that's fine. And I'd really like to just go through a couple of the complementary issues that go through that. So as we saw a little earlier, our risk managers and clients and so forth are really facing some difficulties, whether the hard market's been driven by issues of our own or major global events like the weather, capital shortages, and the like, people behaving badly in various ways. And then also some of these outcomes in the South African context are worse than they should be because of the lack of infrastructure, response capacity, water in the pipes, and many other things like that. Businesses that struggle financially also probably don't do as much risk management as they should. And then you've got the massive natural catastrophes, which unfortunately are coming a little bit closer to South Africa as well. So we need to consider a little bit of that in the way in which we consider how we insure ourselves and develop further. So, when we look at the stars and say, how on earth do we solve this problem? It's got to be in a theme of better knowledge, better analysis. I think the infrastructure and the products are a very complementary part of it. But when we look at this and something comes out of the blue, how do we respond? And absolutely having facilities and cash flow available is one of the solutions. But let's just go through what it means to have the most effective outcome and combination of the ART vehicles with getting the risk transfer right. And so in this context, there are three building blocks. There could be 5 or 6, but with all these issues, you start with the basics. It's already been well discussed in the earlier presentation that the main products are your contingency policy, sell and protected. But I'd like to go a little bit further in some of these areas. And that is that we really need to see the development more of a mutualization of risk. And that could be through either of these products, and it could be on and offshore in the context of first party, and noting the issue about wholly owned first party captives. I think this is a great opportunity to sidestep that matter and go into a blended vehicle, which is not a wholly owned captive. And of course, a lot of this theme was started by Guardrisk in terms of financing risk efficiently. But at the end of the day, what is the real total cost of risk? And it's not only the insurable cost of risk, and that's really the picture of the iceberg, what's below the water level. And real cost of risks are not only insurable risks, they're wide risks, they're strategic risks, they're issues, not even the deductibles and so forth. They could be things like loss of market share, they could be market penetration, there could be many other strategic elements to a business. And so when we look at this, I know we're dealing with difficulties in the context of the hard market and so forth, but the good opportunity in terms of facing the insurance market like this and thinking more strategically down this road is we can solve a few more strategic issues by really looking at this issue in the totality of risk, but starting with the real issues about risk, and then also making sure that we're minimizing any claims and costs that are avoidable. And that comes straight back to risk discipline. There's no point trying to pay money out of a contingency policy or a captive or on balance sheet if that risk was avoidable in the first place. And in our experience, many claims remain avoidable through better risk disciplines and better knowledge and better operational risk responses. So this is not only about finance and money, it's very much about on the ground controlling of risks. So that's the first part, but considering mutual risk groups and so forth there, I think there's some interesting opportunities to continue to leverage technology and intellectual property. Then you go a step further and you say, okay, but what about other forms of ART vehicles? So we've been through the basic ones, but now you go to a mutual risk facility that has underwriting capacity. And so it's a small step forward, but these things started many years ago. One was called the Bermuda facility, where you had a whole range of parameterized retentions, which were multiples of what a company can do on its own. So let's say a company could start with a 10 million retention, and we mentioned 100 million earlier. Of course, you can access that through a spread loss. But what about going into a partnership with 10 or 20 or 50 other corporates? Because the mutualization of that risk doesn't have to come because you're members of the same shareholding family, you're members of the same risk family. And those elements, I think, go well. And what happens there is that you leverage your combined capacity and you offer 50, 100, 500% risk transfer through that mutualized facility. And it's a nice alternative to what would normally be called a primary underwriting layer. A cousin of that is the industry risk finance facility. One of the examples of this, and it's a history one, so I can mention the name. It was called the Pender Mutual. It was a fantastic facility in the telco space. They only admitted members once they'd been through rigorous risk assessments. Again, the operational risk is the ticket to the game, not just the money. And unfortunately, that facility closed down because of fraud in the reinsurance space, which could happen anyway, but it happened here. But it was an extremely successful facility at that time, and they built up massive industry knowledge in the telco space. Then if you look at your facilities going further and say, okay, but what should be inside of them and what's outside of them, and how can you integrate these facilities with other ART vehicles? No, the vehicle is not a policy. The vehicle could be a product. So you could put parametric products inside a contingency policy, or you could look at the different kinds of parametrics that go from NatCat to weather, and there are parametrics around that also go to aggregate solutions and frequency solutions. So all of these things enhance capacity. Of course, you can use reinsurance in any form, but ultimately the coverage availability in the market is going to stop. You can't directly insure the weather or frequency of events or otherwise. So building up the robustness of your ART vehicle with a wide range of these products should be part of your medium-term strategy. And of course, in part of all of this, insurance-linked securities provides a lot of the underlying capacity. Sometimes the banks write the parametrics directly off the balance sheets. Sometimes they're combined with ILS, and that's quite nice because a lot of people are looking for enhanced yield and are willing to risk a portion of their interest or their coupon or their capital to do this. And I think this element provides significant opportunity, particularly these days in the hard markets. The third layer of all of this is then blending financial and insurance risk transfer with formalized hedges and the like. Again, we're not offering advice as financial instrument providers or licensed like that. But again, if we're looking at the totality of ART vehicles, we've got to understand that we're dealing with financial and insurance and peril risk. And one of the interesting examples, and it's come back to us in this context, is when the commodity prices go rocketing, the BI disclosed values go through the roof as well. We had a time where this happened to a major client, and it was almost uninsurable to do their BI. The issue, though, if you're in a commodity, the commodity doesn't disappear. So it was actually more effective to hedge the delivery of the commodity than to buy the business interruption insurance. Because the commodity, if it's in the ground or if you have it in stock, where you can swap out the delivery of the commodity, you hedge the price and the volume, and you obviously enter into a futures contract if you need to trigger that, and off you go. Now, we're not giving advice, but I'm saying in the context of strategy and ART vehicles, sometimes we overly focus on insurance, whereas the bigger economic risk to a client is in its market and its trading environment. So I come back to strategy, and we're saying the risk insights optimize ART strategies. And here we've got to say, what are the critical risks to the clients? Okay, so I'm going to jump through the thing very quickly. These are really the introductory pictures. I mentioned the financing risk efficiently theme, but really looking at varieties about mutuality and then parametrics, insurance-linked securities, but really then to expand and understand the full scope of what ART vehicles could encompass. And then, of course, bringing in the financial element, always cautioning that we are not providers of financial instruments in that context. And here we are then now coming to the overarching strategy of an ART vehicle and making sure that we use the full extent of risk insights to optimize an ART vehicle. Now, there's always fashions in business, and now the fashion is to have purpose-based strategy. And so we can have purpose-led ART vehicles. But strategy is important. So the first part of it is reduction of your predictable and frictional costs, but particularly remove the claims that shouldn't be there through good operational risk. Then it's been said we should be strategizing to have alternatives in both hard and soft markets, because this is about building intellectual property that you're in control of rather than being over-reliant on markets. And then, of course, the strategic finance capacity for uninsured risks, which could be anything right through to market risks. So then, what's missing? And in the market and in terms of best practice, what we see is that there's a lack of medium-term strategy to control, in other words, the objective to control all but catastrophic risks. Corporates have a massive opportunity to get a handle on the risks now. The market's telling them that they're going to charge a fortune for left, right, and center. Well, if that's what the market thinks, make up your own mind. Decide how you can take back control of your own destiny. There isn't a proper understanding of proper asset and liability perils. The level of information that both the clients and the markets get and receive, we still think is very thin. And there's significant opportunities that have arisen when the level of information has been increased, but we're talking levels of 10 to 50 times better information. And that means the quality and the comprehensive nature of the risk is a fundamental. So where does all of this go? Well, it's not a news to anybody that chips are in short supply. That's causing difficulties in the motor industry. It's causing difficulties everywhere. But in the context of strategic risk and an insurance policy and all the rest, yes, you can put money aside for a potential loss. But my bet is nobody has got a chip supplier provision in their suppliers and customers insurance policy that goes to a possible earthquake or fire in a major chip manufacturer, which tend to be in the East, because those are 3, 4, 5 layers of supply chain down. So this is currently an uninsured risk, but it's causing massive disruptions in supply chain. And that's why I come back to the fundamentals of strategy and risk to be aligned with ART vehicles and to see what they do. So what if they're two, and I know Taiwan Semiconductor Manufacturing Company is a massive one. I visited that company. And what if they had an earthquake and they went down for 6 months or whatever it was? The current chip supply shortage would be exacerbated. The prices would go through the roof, delays would go through, and people would be generally uninsured for this. So I think the issue about where we go, what we do, what happens to risk, what the kinds of triggers around risks are, and therefore what kind of ART vehicle that you're going to specify and design are really important in the nature of the risks and the clients that we serve. So at the end of the day, let's get the basics right. Let's make sure we understand total cost of risk at a claims level, at an exposure level, and then at a premium and facility level. We've got to move into tailor-made ART solutions, which could involve mutuals, parametrics, and the right. And then ultimately, we've got to say, what is our business about? Why would we go out of business? And in what way would we use ART facilities, vehicles, instruments, guarantees, the like, to actually address the strategic exposures that we have in the market? Thank you.
Thanks, Volker. Just a quick question. You've mentioned as an alternative, you've mentioned a group structure. So like a mutual type of structure where everybody contributes, has got similar type of risk. Now, and I think that helps a lot from building capacity, because not every person can put the cash aside from the start to cover that risk retention layer that he wants to. How would you consult on the basis where, because everybody needs to work together. So you have a scenario where you have 10 partners on it. You made the comment, which is 100% for this, that the risk needs to be well managed. The risk needs to be good, because before you can join this. But let's say you have those losses. How do you balance that out? If you have one partner maybe having a significant loss eating into the funds of the rest of all the other contributors, how do you manage the risk that he doesn't exit the vehicle, let's say in a years later, and you're not recouping, the best of the members are not recouping that funding?
Yeah, absolutely, Monet. So the rules of the game, or the participation rules, must do that and manage that. So you don't enter these things without being at least a 3 or 5 year commitment. But it's exactly what you would do to your spread loss policy at 20 million a year you're in for it, okay? And then what you want to do with that structure is minimize your reinsurance, which is exactly that. But what you're getting is, with that commitment, you commit to a standard of risk management, a collaboration approach, and your inverted commas 100 is 100% of what your appetite is. So you could go in with 100, your neighbor could be at 50, and your other neighbor could be at 200. It's all proportional to how you want to do it. But the quality standards are clear, and the time commitment is minimum. So you're in for that process. And obviously you can leave if you're not in overdraft or in excess, and then you can come and go. So those rules of the club rules can easily be defined that way. And then you start obviously with a core group where your synergies make it viable to give you the critical mass, and then you can grow it from there. But I think these are the kind of things that haven't been explored enough. If you look at, South Africa's good at mining, but for goodness sakes, we pump tons of premium offshore. And so a lot of these things happen in other sectors. So I don't think enough has been done to properly understand the risk and then respond to the opportunities of knowing your risk better. Because at the moment, all we're really doing is we're getting pricing quotes. We're not saying we know the risk, and because we know the risk, our client should be better treated. That's really our positioning, is knowledge of risk. And that actually creates massive differentiation opportunities, including mutualization.
Okay, thanks for that. All right, thank you everyone. So just in closing the meeting, maybe I've got a last question. It's maybe a tongue-in-cheek question to all panelists. Talking about alternatives, do anybody have an idea for an alternative in terms of the current power crisis that we're experiencing? Because if you take today's weather, solar is definitely not the alternative. So anybody can maybe have a quick answer of solving up that problem today for the members in the audience. I think that leaves it. All right. Thanks, everyone. Thanks for your time. Just from my side, thanks for UMSA for arranging this. Thanks for the speakers, everyone for sharing their insights. And then lastly, to all of you, thanks for making the time to attend. Please, again, remember to complete the survey and to let us have your thoughts. Thank you all and have a great day.
A global leader in insurance broking and innovative risk solutions, Marsh provides personal and business insurance solutions to protect our clients' businesses for future growth while offering lasting peace of mind.